Markets are continuing to rally off of the negative GDP, two consecutive negative GDP prints, technical recession, and the Fed interest rate hike on the hopes that the Fed was dovish enough to sort of say they were kind of going to pivot, although that's not in all likely, and that's not what the Fed was saying. In fact, they said we're going to continue to raise rates, but some investors interpreted the Fed's statements yesterday as a backing off or easing up, if not somewhat of pivot talk. And the markets have reacted and responded accordingly. The other thing we're going to look at is the battle for the moving averages. I'm going to show you some interesting stuff there on the weekly moving averages. But right now, markets are up again today. The NASDAQ up 1.7%, S&P 1.35%, Dow Jones up 0.8%. There's an hour and a half left to go in trading, so we'll have to see if the market closes out here, up or down, and that's really where you know the investors stand, is how the momentum into the close looks. Of course, corporate earnings have been out. Apple beat earnings, which has kind of held the market up. Google, Microsoft, Facebook, kind of all over the map. Facebook wasn't good. Microsoft and Google were not good in terms of earnings, but were putting forward some very aggressive and positive forward guidance, which kind of encouraged the markets to keep the rally up. So we'll just have to see if that can maintain the markets as we go forward. Inflation figure that the Fed follows closely hit its highest level since January 1982. So inflation is still an issue that the Fed has to deal with. So that's just showing you that they just cannot pivot anytime soon. What they've done so far hasn't had a chance to impact the economy or inflation. As we all know, inflation's pretty sticky out there. The only thing that's really come down are gas prices, and that's been mild at best in most areas. And mortgage rates are dropping a little bit because the other big story that not a lot of people are talking about or paying attention to are the bonds. 2.6% on bonds. Mortgage rates are loosely tied to bond yields because that's in large investors looking for the safety play, risk-free assets. So all of the large investors are flocking into bonds right now on recession fears and inflation concerns. So that tells you a lot right now. Whereas risk assets popped on the earnings and things like that. So we'll just have to see if this is still just a bear market rally or if the market can sustain the momentum. And right now, most of the indications would point toward it being a bear market rally. So let's take a look at what I was talking about in terms of markets fighting for the weekly moving averages. And here's Bitcoin on the daily chart here, just kind of continuing its upward consolidation range, kind of like it did here. Hasn't been able to break this top range of this current area here that we've been watching yet at that 24. Let's zoom in a little bit here. 24.2, 24.3 range. Could see it get up. Could have seen it get up to about 26, but it seems to be capping out here with like a double top kind of going on there. So we'll have to see if that's all she wrote for Bitcoin in this range right here. But here's what I'm really looking at that's interesting. Let's go ahead and get on the weekly chart. And let's look at the moving averages. And we have this 50, 100 week moving average cross getting ready to happen. And we look at where this has happened in the past. Obviously in 2018, the bottom was already in when that cross happened. So the low range, bottom of the range, the lower area of that range, it had already bottomed by the time these moving averages crossed back in 2018. If you go all the way back to 2014, same thing, these averages crossed. The market had already bottomed over here with a wick low, but then it went on and checked that bottom level again. And from the 200-week moving average, that drop was about 28%. Over here, same thing. When this cross happened, the market bottomed and checked the 200-week moving average again, checked the range low again. I think that's the last time until now. We're about to get it. So the real question is, will this moving average cross? And if it does that mean the bottom is in, and will it come down and revisit that level again? And like I said the other day, I fully expect Bitcoin to come back and test that lower level again. But let's say it followed suit just like it did in the past, and dropped 28% from where the moving average is right now, what would that do if it came down and broke this low on a retest right in here and broke down 28%? That would put it back in that 16.2 range, kind of like we've been talking about for the last few weeks, which, you know, puts price in this area of consolidation here where there's a little bit of support. If we look at it on the daily, we can see that even better. So let's go back right here into the daily, where you have, you know, a lot of support and resistance in that 16,000 range right in this area here, for price to get kind of hung up on right down in here. So we'll have to see if price is going to break that level and go down and check it like it's done in the past. And the other thing that's interesting is to look at this same metric on the Dow Jones. So we've got a nice curvature going on here where it looks like the 50-week is headed right for the 100-week. And what does that look like in the past for the Dow Jones? The last time it happened was right here in 2016, when the market kind of crashed back in 2015, 2016. Oil prices dropped all the way down to 21 bucks a barrel. The Chinese markets were in trouble, and price went down. The Dow Jones went down and found support at the 200-week moving average. Time before that was March of 09. The 50 broke down below the 100, then it broke down below the 200, and ultimately, you know, found a bottom down at 67.46 back in 2009. That was a big, you know, that's your panic selling market right there. And then the time before that was obviously 2001, when 2001, when the 50 broke below the 100, ultimately below the 200, and it went into, you know, put in a bottom there around 7,200, broke lower in 2009. Of course, that was a different environment back then. It was a banking crisis. Here is the NASDAQ, same thing. The 50 is hooking down, going after that 100-week moving average. Price has found support at the 200-week, which it did at March of 2020, not quite in 2018. So let's look at the last time the 50 crossed down on the 200, almost here in 2015, 2016, but not quite. But again, same thing, 2009, 50 broke the 100, then the 200, and the market ultimately found its bottom at 1,029 on the NASDAQ. And then again in 2001, obviously it broke below the 50 and the 200 and ultimately bottomed at 811. Right now it's at 12,925. So not a bad little move since 2001 for the NASDAQ. And then S&P, same thing. That average is hooking down, heading for the 100. The 50's coming after the 100. 2020, it broke below the 200-week moving average, found support in 2016. Broke below, again, 50 broke below 100 and 200 down in 2020. This was my first foray into the markets when S&P was at 600. Dow was at, I think we said 3,000 or something. What was the Dow back then in 2020? 6,500. Yeah, it was Dow 6,500, S&P 670-ish. So that was my first entrance into the markets back then when that happened. And then the time before that on the S&P, again, was 2000. Broke below the 50, broke below the 100, went down and found support at 774. Broke lower than that again in March of 2009 during the great financial crisis and banking collapse of 2009. So it'll be interesting to see if the markets continue on, if these averages continue to cross. But the moral of the story is, in Bitcoin, when these two averages crossed, the bottom was already in. But on the Dow Jones, as we can see in the past, the NASDAQ and the S&P, the market was was not at the bottom yet. It went down. Let's see how far it went down. Once it crossed at this area here. The market went down on the S&P. I mean, that was a big issue, obviously, back then. But let's just see. I mean, it dropped another 50% back then. The Dow Jones, the most relevant one would be the 2000 and the 2009. So from the cross on the Dow Jones back in here, roughly probably the same thing, about another 40%. So the market bottom was definitely not in. And, the question is, could it potentially cross out in this area somewhere and break down another 30 or 40% from here? I mean, that puts it back down at the pandemic level lows. Some analysts are calling for that. I'm not saying that's, possible, likely, anything like that. I'm just saying, if you look at when these averages crossed in the past, and obviously they're lagging indicators, so they're just kind of following price action anyways. Markets, if everything changed, the Fed came back in and pumped another 2 trillion in, markets would reverse, turn around completely, and the moving averages would continue on just like we saw them do. Well, let's take a look at it back here, because they were heading for a cross right here in 2020. And then obviously the market was off to the races. This is kind of indicative to where we're at right here, as far as that little dive towards the 50 at that point. But then, obviously we had that V-shaped recovery with the Fed coming in. A lot of people are kind of getting caught up thinking we're seeing something like that here, but there's no liquidity coming into the market at scale to do that. All of the big capital is going into bonds right now. This is short covering hedges and, risk on trade right now based off what the Fed said, still kind of on that sugar high from the Fed meeting and everything, and some earnings. Some of the companies were positive like Apple and, things like that, but a lot of it is speculative right now, just trying to make up for some lost ground. Here's Bitcoin on the hourly, kind of working its way up in this range, trying to, maintain this level here. So we'll just have to see if it breaks down over the weekend, and then ultimately next couple of weeks comes back down to check this low and see if the bottom is really in, or if it's going to break down below and get down to that 15.5, 16,000 level, and then maybe find a bottom in that range. Or is this a bigger bear market than we think? Recession is worse than we think, and we go into a longer, more consolidated bear market. So right now, we're just going to have to wait and see how these things play out and what the environment looks like and what the economy is going to look like once we get through the summer and we get through the rebound from the pandemic in terms of everybody getting out, spending money, taking the summer vacation. When reality sets in this fall with college tuitions, back to school, holidays, things like that, and real, issues of people running out of their savings, maxing out credit cards, and just, simply not being able to keep up with inflation. So those are the things I'm looking at. I'll see you in the next video.